So welcome to Money Talks. Today's webinar is about retirement and pensions. And today I'm joined by Guy Skinner of Citygate Financial Planning. And I'm just going to kick straight off by handing over to you, Guy.
Well, thank you very much for having me. You asked if I could explain who I was and why I do what I do. So I'll start by answering that. So I've been a financial advisor for 16 years. I fell into this originally. I think a lot of financial advisors do fall into financial advice. It's kind of a common thing that we hear. It's not really something your careers advisor ever says you should do this, and it's not actually something that many people know what we do or how we do what we do. But people are aware of things like pensions and mortgages and the products that are the tools of our trade. But you don't think about a plumber and think that they don't fix your leaks and just think about their spanners. You think about the fact that they sort out your plumbing. So there is a key distinction, and too many people don't think about what we use things for and why. And that was the main reason why I actually stayed in it once I came into it. So my dad died actually when I was 10 years old. And I was very lucky to have had that experience in many respects, because he was the managing director of a company and he had a lot of life insurance. So the very fact he had a financial product was the reason why I had a better childhood than I perhaps otherwise would have done. And that's what very much inspired me to stay in it once I came into it, even though I fell into it. And it's very much what drives me. So the reason that I'm really passionate about making sure everybody makes the right choices financially is because obviously I've lived that experience. And that's why I want to help educate as many people as I can so they can make the right choices with their own money. It's beneficial for their children, but it's also beneficial for them. And if they can be wealthier because they've made the right choices, then great, I'm all for that. So the way that I would typically work with any prospective new client and try and explain anything to anybody, we do webinars and seminars for employees of companies where we manage company benefits, is actually using stories and sketches. So I find stories powerful because if I can make people feel something, they'll probably remember it far more than if I just quote a load of facts at them. And if I show you some sketches, you'll probably remember the visuals from that as well. I think about 80% of people are visually stimulated. So the other 20% of the audience I might not land with, but hopefully the 80% will actually remember a lot of the stuff that I talk about. So there are a number of questions that have come in on there, and we can come to those. But if you're happy for me to just crack on, and I'll walk people through what their life might look like. And I've got to apologise as well, because I am very stereotypical. And I'm talking about 2.4 children and white picket fences. And I know that's not going to be everybody's life, but we'll see if this resonates with everyone. So if we've got a simple timeline, we've got 3 points in our timeline. We've got now, which I'll just call X, because it depends how old you are. I could put myself on there, so I'll just tell you all I'm 43. We'll put here as Y. For me, that might be when I'm 60. And we'll put Z. So I'm going to hope that I'll be 100.
Nice.
And sadly, it comes to us all. We can't escape it. That's what happens there. Okay. Now I'm 43, but when I was 25, I was probably earning that amount, and hopefully it's going to get to that one by the time I'm 60. So 60, we might call that our retirement age, and that's what we're talking about today. We're talking about pensions. So the key thing about pensions is obviously they're the main tool that people use for retirement. Retirement is also kind of known as financial independence. So that line there represents a line in the sand of that's when we're independent financially. And what that means in some senses is that we have 4 aspects of money. Things that we owe, things that we own, we have money we earn, and we have money that we spend. So they are the only 4 things that you can do with money: spend it, earn it, own things, and owe people money. And what we do as we progress through life is we hopefully pay off the loans. The mortgages have gone, loans have gone, stuff like that. We get to a point as well where we stop working, potentially, or we might taper, but we'll stop earning. And for every single person, eventually what you own will have to pay for what you spend. Really simple concept, but not too many people think about it. And that's effectively your pension is an asset, it's something you own. Eventually that's going to pay for your lifestyle and what you spend. So we have to have a pot of money here that's going to generate the income from there to there if we're no longer working. Now, if our income's doing that, we'll tend to find that our expenses will do something like that. So we've got various people that will be listening to this. We've got people that I might refer to them as dinkies.
explain dinky?
So a dinky is a dual income, no kids yet. So it's a couple with no children yet, and they're probably the richest they're going to feel for quite some time. As soon as they have children and they get into this point here and they've got a greater level of expenses, this could be because they've got school fees. It could be because you've had to move from a 2-bedroom flat to a 3-bedroom house and you've got a bigger mortgage. I can spell mortgage, promise. My wife, for example, she works 1 day a week, so we're near enough 1.2 income. Our earnings have gone down. There could be other things. It could be university over here. It could be that we build an extension on a house. There's all sorts of things that will impact our experience of money here. I'm 43, so I'm probably here if that was 25. Funny thing, actually, if you look at the happiness, generally speaking, of people in life, happiness looks something like that. We're all aware of midlife crisis.
Yeah.
And it's partly to do with the fact that if you look at how your cost of living and your income, it's the fact there's this squeezed bit in the middle here.
Yeah. So the point where we all go out and buy a sports car is actually the point where we can least afford it.
This is probably right. Yeah.
Excellent.
Yeah.
Good news for
So
everyone.
we kind of have two distinct points in life where the amount that we can save is either side of this big expensive part in the middle. Now, too often people will say, I wish I'd saved more when I was younger, and they think about retirement when they get to this point here. Okay. There are a lot of advantages of saving early. We're all aware of compound interest and compound growth. Einstein referred to it as the 8th wonder of the world. So those that understand it receive it, and those that don't pay for it. Okay, so it's just growth on growth, but there are other things as to why it's a good point in time to invest and save. The main one being risk. So the main thing that I find when I speak to people is that they don't take enough risk with how they've got their pension money invested. If you've got the best part of 40 years, if you're in your early 20s, and it might not be 60, 65 till you can take the pot, you've probably got the best part of it. Could even be 6 economic cycles in between starting work and looking to retire. So you can actually take the highs and the lows and the volatility that you would get with the stock market. But statistically, only 10% of people actually move out of the default fund that their employer puts them into in a workplace pension. So that's probably the first thing that if I could get everyone to take one action, it will be to review the investment funds that they're in, make the right choice, obviously, for you, but think about what your risk profile is. And you probably want to be higher in terms of global equities as an asset to be investing into than government bonds and things like that, which essentially is an IOU to the government. And it might only give you a rate of interest that's not too much above, but more likely below the Bank of England base rate. And that's not really going to compound at any great level to try and give you a decent sized pot for retirement. So people will also ask me, how much should I save into a pension? And that's probably a question we're going to have later, right? Very often it comes down to how much of a drop in the standard of living do you want when you actually come to stop working. So if that's what we were earning, we've got to take it and accept the fact that we're going to earn less when we're in retirement. And if I just use some nice round numbers and I say that this is £50,000 per year that somebody wants, round numbers are great because they're easier for quick multiplications when I'm talking about stuff. But look, that is also what's recently been in the press as being a comfortable existence in retirement. £50,000 per year. You can have a couple of foreign holidays a year. You've probably got no mortgage at that point in time as well. So after tax, that level of income, if it's between two people, they're both basic rate taxpayers, it's actually quite a nice level of money to spend each month. You can buy more than a Costa coffee a day, put it that way. So how big that pot would have to be here to give that level of income? If we consider the fact that there should be 2 state pensions, again, I'm talking 2.4 children, white picket fence. We've got a couple here. They've got 2 full state pensions. Well, that's 20,000 roughly, 10,600 each of income from age 67 or 68, depending on your date of birth. So we're looking at about £30,000 from 68 on top of the state pension. It's actually a multiple of about 30 times as to how big that pot would need to get to give you that as a sustainable income inflation link right the way through. So we're looking at about £900,000 as a pot size. So if that's the task in hand, you might have 40 years to achieve that. You might have 17 years, if you may, to achieve that, right? So you've got to think about where you are on your journey and what the standard of life is that you want when you get to retirement. It's not obviously just about pensions, but there are a lot of good reasons why we use a pension. So if we think this is a pension, it's just a box. But if we're a basic rate taxpayer, we put 80 pence in the pound in, we get a pound invested. Okay. If we're a high rate taxpayer, we put 60 pence in, we get a pound invested because we get our tax back. Okay. When we come out the other side and we want to take income out of it, we get 25% of it tax free. You're probably aware of that. And then if we were earning £50,000 a year, we'd actually be basic rate taxpayers. So we'd only pay 20% tax on what comes out. So we're actually going to pay, if that was 75 pence in the pound left, we'd get 60 pence of that 75 pence after tax out. Okay, that's the 20%. So we're walking away with 85 pence in the pound, having only invested 60 pence. And that's if we took it day one. Okay, so there's not too many investments where you can get actually a 66% return day one. So 60p to a pound. And equally, a pension is a protected wrapper. So when you put money in there and you invest it into the stock market, you get the capital gains tax-free, you get dividends tax-free, and if you've got investments in there that yield interest, so you have got some government bonds in there, it could be commercial property in there, and you've got rents being paid, all of that income is tax-free and it grows. So now, there's not just the long term to consider, we've also got the medium term to consider. You do need pots of money for these things here. So you have to think about a pot of money there, and also we should have a pot of money in the immediate term as well. So this will be cash, and I won't labour insurances right now. Obviously I spoke about my dad, but conceptually that's where insurance would fit. If you do think about insurances, the duration of risk is from there to there, okay? But you can't neglect those things. So if you think about defined benefits pension schemes, again, I know quite a few people that will be watching this and listening to this will have defined benefits pension schemes. I've over the years looked at a number of British Airways ones, for example. If I talk you through how they're actually funded, typically they work on an accrual rate. So they work on an accrual rate normally of 1/60th every year that you work at the company. So 1/60th, the reason why they're called final salary pension schemes is whatever that salary was there, for every year that you work there, you got 1/60th of it. But it's to a maximum of 40 years. So if you started working at 25, retired at 65, you'd get 40/60ths of whatever that figure is there. So if that was £100,000 a year you earned as your final year of work, you get £60,000 a year every year, the rest of your life, inflation linked. That's why they're gold plated, okay? Because you don't have the risk. Even if British Airways goes bust after you've started taking your pension pot, you're protected by the government. You'll retain that income. Now, how companies funded these things, effectively, you've got to be contributing for 40 years. And they typically put about 33% of your salary into that pension pot for you. Okay. So if anybody out there at the moment that's not in a defined benefits pension scheme is going to be saving for 40 years and a third of their salary, you might be able to get the same level of income. All right. But I guarantee there's probably nobody doing that. There might be one. Right. But if you think about how much you're putting in under auto enrollment in your workplace pension scheme, it's 3 + 5. That's the minimum amount on pensionable salary. So you've got 8% going in. And if you're 43 like me, you want to retire at 60, you've got 17 years at 8%, you've got no chance of getting anywhere close. So a rough rule of thumb is if you take your age and you divide it by 2, as a percentage of what you earn, if you could put that amount into a pension for the rest of your working life to age 65, you'd have about half of your average annual income from your working life for the rest of your days. Okay, so take your age, give you an example then. So if somebody's 34 divided by 2, so 17% of their salary, they could put that away every single year from 34 through to 65. And say they were earning here 20,000 and 100,000 there, their average earnings is 60 grand. So that plus that divided by 2. So if you could do 17% for the rest of your working life to 65, you get to that £60,000 per annum figure. Okay, that's a rough rule of thumb. When we are decumulating and taking income out of our pension pot, again, I just gave a 30 times multiple. There are other ways that you can think of it. We've got the go-go years, the go-slow years, and the no-go years as a way of thinking about it as well. So we might have the go-go years, the first 10 years of our retirement, the go-slow, the second 10 years, and then the 30-year retirement, the last 10 years. We might deplete that pot by a rate of 5%, 4%, and 3%. Okay, that's another way of thinking about how you might actually how big that pot needs to be. But the best thing to ever do is think about how would you actually live your life? So it's all well and good aiming for an arbitrary number, or, you know, my next door neighbour wants £50,000 a year, so I want £50,000 a year. But think about what the standard of life is that you want. Think about what's important to you. What are your values? Do you want to help children onto the property ladder? Do you want to make gifts so that you can help son, daughter, whoever it might be mortgage free, or get on the property ladder, or whatever it might be? And you've got to factor these things into retirement. So a pension is a vehicle, and it sits in this journey that we call life, and it serves a function. But the problem is you've got to think about all of this. Okay, so if you don't put it all into context, it's just an arbitrary thing that kind of sits there. So I'll take a seat now, and I might refer back to this, and if people can read those hieroglyphics still, then that would be great. But
okay, it's a complex message. It requires a complex diagram. That's fine. Okay, well, thank you for that. I feel like I've learned at least 4 things just from this, so hopefully everybody else did. So if it's okay with you guys, I'm just going to crack on with these
absolutely,
questions. Let the grilling commence. Okay. So first question, and I feel like I already know what you're going to say to this. Should I opt out of my pension?
Yeah. So it's probably the only time you're ever going to get free money in your life. If we think about even a basic rate taxpayer, under auto enrollment, they've got to put in 5%. Minimum their employer will put in is 3%.
Sure.
If 20% tax relief is 1% of the 5%, for 4% you're getting another 4%. So you've got 100% return day one. Now, if I could go and open a bank and I could promise everyone that deposited money in it, they put £1 in it, that they'd have £2 when they looked at their next statement, I'd be the busiest bank in the world.
You would?
I probably would.
Yeah.
But because we call it a pension, people are a bit scared of it. Now, there is a little bit of a string attached in them, in as much as you can't touch it until you're at least 57, if you're not 55 before 2028. But it's the most tax efficient place that you could hold money to grow. And people just aren't aware, I suppose, of the other aspects of a pension. And if they now they should know a bit more about it, they probably won't opt out of it.
What are the benefits of having a pension?
Okay, so yeah, there's obviously the tax relief on the way in. We've just spoken about. There's the fact that your employer will contribute as well. There's the fact that the growth that you receive on it, it's similar to an ISA in as much as it's protected from any tax being taken on the income that the investments return or the capital gains of the investments. A pension also sits outside of a person's estate for inheritance tax purposes. So if I'm working with really wealthy people, we are saving into pensions, but actually we might never touch that pension. It might just be something for their next generation or even their grandchildren that they can receive after that person's died. But it's a great way of passing on wealth intergenerationally. We had a few rule changes in 2015 called the Freedoms and Flexibilities Act. You might remember headlines, because it's only 9 years ago, but people were talking about people buying Ferraris and Lamborghinis with their pension funds. And that's because we can now access them in their entirety if we wish when we get to retirement age. But the quid pro quo of that was that the death benefits were enhanced in terms of them not being something that we had to automatically annuitize at age 75, and also the fact that they weren't taxed when we died.
Okay. Should I opt out of my pension if I don't think I'll retire in the UK? And what would happen to my pension if I do move abroad?
Okay. So from the last question, I would still argue you shouldn't opt out of your scheme, even if you're thinking of retiring abroad. You can actually have a pension pot accumulated in the UK and then draw it either to the country that you retire in. It'd be subject to local taxes if you did that directly, or you can take it out still within the UK and have it paid to a UK bank account, pay tax on it in the UK, and then move the money to that other destination, wherever that may be. In relation to, it's not asked in the question, but in relation to state pension benefits, you need at least 10 years of a working national insurance record to actually get any element of the state pension if you do move abroad. So there will be people that might have lived in the UK for 9 years. They could actually top up to that 10th year before they leave the UK if they know they're about to leave the UK, and then they'll get 10/35 of what the state pension is. But they otherwise wouldn't get anything if they left with just a 9-year tax record. So if you are thinking of moving abroad, they are still viable. It is still a good thing to do. You can move the pot from the UK to what we call a qualified recognised overseas pension scheme, a QROPS. And you should seek expert financial advice on that. It's not something I actually deal with. It's an area of expertise that people just do that day in, day out. But the taxes could differ. So obviously Brexit made an impact upon the tax rates, and different jurisdictions will charge different tax rates. But if there's a dual taxation agreement between the UK and the other country that this person may retire in, then you might find that there's actually credits could be generated. Malta, for example, has got a lower tax rate than the UK, and it's a popular destination for people to retire in, partly because of this fact.
Okay, so next question. I like this one. I feel like you kind of explained it. But how much should I save for retirement?
Okay, so I think one of the common challenges that people have actually, and if I'm talking about the first principles of any financial plan, irrelevant of how much you should save, should be how much do I spend and what is my day-to-day living.
Yeah.
So we've all probably got superfluous items each month on our living expenses. So, you know, people might have 2 Netflix subscriptions but not even realize it. But the first thing that everybody should do is actually have a budget.
Yeah.
So if we all know what's coming in each month and what's going out each month, we can start chipping away at what's not coming in. What's going out.
Yeah.
We might even find other sources of income if we really put our mind to it. There could be stuff that we could sell in the loft. There could be other methods of getting some marginal levels of income. But we've got to identify what is the spare amount of money that we have.
Yeah.
I would argue that we should always have an emergency fund. So every single person should have 3 months of cash, ideally.
Yeah.
For the fact that if the roof has a hole in it and it's raining like it is today, you want to get that fixed. If somebody prangs your car, you've got to get that fixed. If the boiler goes, you've got to get that fixed. So normally 3 months of cash in savings is important. Ideally, you'd have insurance to pick up the slack if you had ill health and you couldn't work for more than 3 months. And so if you've got those things in place, then you can start to look at doing simple things like investing into a pension. I'd also be inclined to look at paying off debt before I would invest into a pension. I'm only really talking beyond putting into a pension further than what you would get through your workplace scheme.
Sure,
That 100% free money is 100% free money. So I can handle a little bit of debt if I'm doing that. But beyond that, we might think about paying off some debt before we'd even put in money into a pension. You know, if somebody's got 27% APR on their credit cards, well, they should be coming to you guys first and foremost, shouldn't they? But
yes, they should.
but maybe they'll pay that off before they put the marginal pound in a pension. But as I was saying, you know, there's a couple of rules of thumb in terms of 50% of your age, and that's a good place to start. But you need to be saving for about 40 years to do that. But knowing how much is enough is kind of the key. I'm not a big advocate of people over saving. So if we can actually figure out, and this is what we do for clients, if I expect people to live to age 100 and I can actually roughly build a cash flow model, I know it's going to be wrong, but we could all do this ourselves. We can allow for an assumption of inflation at say 3%. We can allow that 50,000 to go to 50,000, 3%, and so on for a period of 40 years. We've got a rough idea as to how much that pot would need to be, and we're going to spend it all. But there's no point saving too much and just dying really rich. So there is a fine balance to achieving all of this.
Yeah.
And having a rough idea of what you want the future to look like is really the start point of that. Yeah. But I'm fairly confident most people don't save enough, is probably the first thing I'd say. And just because auto enrollment is 8%, there's probably a bit of a fallacy out there that, well, the government's going to take care of me and they've probably recommended this amount. Auto enrollment actually started in Malaysia, and in Malaysia they save 27% of their salaries, and something similar to auto enrollment. Australia's 12%, and we're at 8%. So that'll probably be the next iteration of auto enrollment, the increasing levels of savings.
Interesting. What's the best thing for young people now the pension age is being pushed to 71?
Okay.
A pension's still the way to go.
Yeah. So that was something that was in the press the other week, and that's just relating to the state pension age, and it's not actually statute yet. So 71 is something that's been spoken about. The final baby boomer will retire this year. So every baby boomer, by definition, 1964 was the last year of the baby boom generation. So this year, that'll be the end of their generation. And I suppose as a society, we are struggling to afford the cost of all these retirees. We're living longer, less healthily. The NHS is costing a lot more than it was, particularly after COVID. So something has to give at some point. I think it's the greatest social contract there is the state pension. I think if that was taken away, there'd be rioting on the street. genuinely. It might get moved to 71 at some point in the future, but it's just literally the state pension.
Okay.
So that doesn't mean it's the death of pensions, because what I'm talking about there, where I talk about that £900,000 pot, is a defined contribution pension scheme that you can have through your workplace.
Yeah.
So if you still want to stop work at a reasonable age, then actually that might just be more of the agenda, actually, that you've got to save more into that to bridge that 11-year gap before you start getting your state pension. And I think, anyway, I don't even think many years down the line this will come back to haunt me, but I don't think the state pension will ever be means tested. So I think that will still be something that will be available even if you're a millionaire. If you've got the national insurance record, you'll receive it. Again, it would just seem a very unfair thing that if you've made provisions personally, that then counts against you for the state pension. But what a lot of people don't do is save enough. So the average retirement pot for a 65-year-old is about £65,000 in the UK right now. So yeah, if we divide that by 30 and then give somebody a state pension, people aren't going to have a great retirement on that. So it's more than you think is the answer. And going back to something else I said earlier, if there's two levers you can kind of pull in terms of making sure you've got a good retirement pot, it's saving more money, and it's also taking a bit more investment risk so that you can try and get better returns.
Kind of links in the next question, but how do you know if you have enough to retire? So we talk about, you know, imagining what we might need, what sort of lifestyle we might want to lead, but how do you know for sure?
There's only one definite way, really. Okay.
Don't say try it.
No. There's I suppose there's two definite ways, right?
Okay.
You've either got a defined benefits pension scheme through your workplace.
Yeah.
So by definition, the benefit is defined. That's why it's called defined benefits.
Yeah.
You know what you're going to get. And so long as that plus the state pension, you can live within that, you're never going to run out of money. And when they're in payment, the government is underwriting the cost of that scheme, if you like. So only if UK PLC goes bust do you have a problem. We've all got a problem at that point, is the reality. We'll be running for the hills and trying to catch chickens and stuff like that. We're all in the same boat at that point. The other way of kind of guaranteeing it is that you can buy what's called an annuity. So annuities, essentially think about life insurance, but in reverse. So you give the insurer the lump of money, so in this instance, £900,000, and they give you the premiums for the rest of your life. Okay. Now that is also a contract at outset that you know that you're going to get that. So that is another way of guaranteeing and knowing what you're going to get for the rest of your life and knowing it's enough. So long as you know that your state pension, when you get that, plus what that annuitized income is, and you'll know when you buy an annuity, is it going to be inflation linked? Is it going to be level? Will it have a death benefit built into it for any spouse that you might be survived by? So you build in some level of certainty, but they're the only two things. The alternative for most people at the moment will actually be what we call income drawdown. So I'm pretty sure this is another question we come on to later in terms of how do we take the benefits. But the third option effectively is that you have that £900,000 invested and you just drip feed money out of it through your income tax bands, and you leave that money invested and you kind of take your chances on the mercy of the stock market, which sounds really risky and it scares a lot of people. But actually the stock markets globally, they fall 1 year out of 5. So if we start on the 1st of January, we take it to the 31st of December, 1 year out of 5, they'll actually be down by the time you get to the end of it, statistically. Okay. That's not to say that it's a comfortable journey. You know, I walked here through the park and it's quite a meandering thing. It would be great just to have straight paths in everything in life, but that's not the reality of life, is it? So, you know, we can see with the stock market peaks and troughs of about 15% into year. So if you take the FTSE 100, for example, within the year from the 1st of January to the 31st of December, it might have been down by 15% at one point in time, but it's still up by the end of the year. And we've got to be accepting of that volatility to be an investor. So we're either really optimistic, which is great, or we just don't look at these things at all, which I'd argue is the best thing to do. So if you put money in a pension, take a good level of risk with it, and just don't look at it.
Don't look.
Just don't look.
Okay, just don't look. What is the best option if you're self-employed?
Okay, so if you're self-employed, you obviously don't have a workplace scheme that an employer is contributing into, but you've still got the same tax benefits of a pension that an employee would have.
Yeah,
So you're still going to get your marginal rate of tax relief when you invest. I could make other arguments for why pensions are actually really useful vehicles and people don't know about it. You can, for example, if this person, for example, if they incorporated and set up their own limited company, you can use pension funds as a source of funding to buy shares in companies. You could make loans to yourself. You could buy commercial property, which might be then the premises that you have your business from. And then your company is paying rent to your pension fund rather than to a landlord. So there are other ways that you can use a pension fund. And I've got clients that own restaurants and dental practices, office buildings, and they occupy the office buildings with their companies. And it's one of the best ways you can actually grow the money.
How should I invest within a pension?
Okay, so just because I'm a 10 out of 10 on a risk spectrum, I know not everybody is, that we need to have diversification within whatever we do. So when we're investing money, it's not a case of having all of our proverbial eggs in one basket. I think a lot of people get caught up in that kind of statement a bit too much, and they think that means we have multiple pension pots with multiple providers. But actually, the all the eggs in one basket kind of proverb is more about the fact that we just buy Tesla shares. We put every penny of our pension fund into Tesla shares. We're taking a lot of concentrated risk on Tesla having a good outcome for us not to lose our money. Granted, we might make 100% in a year for whatever reason, or Elon Musk might tweet something, we lose half of it. But
always a chance.
But what we need is diversification. So we should be globally diverse in how we invest our assets. So we should be across the US, the UK, Japan, emerging markets, Europe, and so on. And then we should have, really, I only kind of view there as being two asset classes or two different things you can invest money into. So I don't really believe that gold bullion, for example, is an investment. The reason being, it doesn't have any utility. We're not going to get paid a rent for it. We could own this building and we'll get paid a rent. So I'd argue commercial property, if we own it directly, it is an asset that we can invest into. So I suppose that's three, isn't it? Equities is another one. So we buy shares in Apple, Microsoft, whoever it's going to be. We're normally going to do that via a fund because the trading costs of buying individual shares is too expensive. And we might just use passive funds. We might just take a tracking approach to the FTSE 100, the S&P 500, and we've got the risk of every single one of those companies within those indices, and we're highly diverse. And then the third asset class is bonds. So they could be corporate bonds or they could be government bonds, and essentially they're just IOUs. So for a period of 5 years, we've lent them £100. We'll get repaid that £100 after 5 years, and the benefit to us for making that loan is that they'll pay us 4% interest per annum. They still have a fluctuating value on the secondary market because they can be bought and sold, but we know with certainty, depending on the credit risk of the institution that we've loaned the money to, that we'll get £100 back after that term. So they're kind of the three things that really I see that people can invest money into. If we took a scale of 1 to 10 of risk, 10 being me, where I'd be 100% invested into the companies of the world, and 1 being it's not far off just putting it under your duvet.
I think I might be the one.
You're going to probably go up in roughly chunks of 10%. So if I'm a 9 out of 10, I'm 90% equities and 10% bonds. If I'm sort of middle of the road and I feel quite happy and I'm balanced, I'm 50% and 50%. And in middle of the road, 50-50 is kind of where most people's workplace pensions will normally sit as well.
Don't tell me that. I'm going to be investigating that.
Okay.
Right. So if so this says if we, so I'm going to assume that this is a couple. If we have lost pots from other jobs, how can we find them and put them together for future?
Yeah, so this is something I've seen more often than people might imagine, and it's, it makes me laugh sometimes because people would often cross the road if there was £10 and they could go and pick it up, but they forget about these pots of money that are sometimes tens of thousands of pounds, and they've got no idea where they are, and it doesn't cause any distress at all, which I find boggling. But there's something called the Pension Tracing Service. So if you looked on the .gov.uk website, you can Google it, you'll find it really easy as well. But there is a pension tracing service, so you can find out through your national insurance number who is the administrator of the pension scheme, You can still also contact the companies that people have historically worked for and speak to somebody in their HR team, and they might ask you for your old company number and national insurance record and check you out on their HR records, but they'll tell you who the pension was provided by at the point in time when you were working there, so you can make contact. And really, it's your national insurance number that's going to get you most of those things. You could just go to Scottish Widows, Legal and General, whoever it's going to be, and quote your national insurance number. You might have to do, I see this quite commonly as well, where people haven't changed their maiden names, they've got married. You've got to send them your marriage certificate before you can do anything with it, stuff like that. But there is a lot of money that's just not out there, is out there that people aren't claiming and does get lost.
What happens to
them? That's a really good question, and I wish I knew the answer. I could cobble together an answer. I imagine probably insurance companies will take that. There'll be some sort of benevolent fund that goes to eventually, I'd have thought, but
that's sad. Okay. Trace your pension pot.
Yeah.
Okay, so next one. I have a pension that is now closed from 2018.
Mm-hmm.
Should I put it with my current pension, which is managed by Aviva?
Okay. Again, this is a common thing that we deal with. I'm a big advocate of having all of your pensions in one place. So if I have my own business, so I've had the same pension for however many years now. But a lot of people have portfolio careers these days where it's 2 years here, 3 years there, and move on. And particularly with auto enrollment, everyone's now got a pension every time they've got employment. But I would every single time move them and just consolidate them and keep them in one place. A few reasons for that. So I think firstly, it's just the ease of not losing them then, because we all move house. People might be renting or they might be moving and all that sort of stuff. And if you've got to change the address with 10 more pension providers as well as all your utilities and your driving license, it's quite a chore. But the main reason why I would do it actually is because I'm speaking about investments, and I want to know how the money's invested, so it's congruent with what I'm on target for, what I'm aiming for. So if we've got several different pots all over the place, it's really difficult to do that. There can be other reasons. We might find that the Aviva pot this person has got lower charges than some of the other pension pots that they've got. So they're always percentage based. So it's quite easy to discern if it's cheaper here or cheaper there, but we can save on charges, and that's just meaning that you're going to get more of that compounding when it does grow, and your pot will get bigger if your charges are lower. Death benefits is also another key reason why I would consolidate things. I mentioned the Pensions Act in 2015 of freedoms and flexibilities. It is the case actually that, again, you should have nominated somebody to receive your pension if you die. And the number of times I've seen people who've got ex-boyfriends, girlfriends from when they were way back when, and they're now married with children, whatever, actually the trustees of those schemes would be obliged to actually pay it to the person that's nominated. So because we forget about who we've nominated and it was 20 years ago, it can have serious consequences if somebody dies. So to keep it all up to date by keeping on just nudging them and put them together is a useful thing to do. You want to look out though for what we call guaranteed benefits on pension schemes. So we can have on really old pension schemes where I spoke about 25% tax relief. Really old schemes pre-2006 might have more than 25% tax-free cash, for example. I mentioned annuities. So the current annuity rates are about 5% at the moment. You might have somewhere they were promising an annuity rate of 9%, so long as you took the benefit on your 60th birthday. You've got to take it on that one day only. But 9% compared to what you get in the market at 5% is a compelling reason why you might actually leave that pot where it is. So you've got to check that there aren't any of these guarantees. So if you ask a pension provider for a transfer out statement and just ask them, are there any guaranteed benefits within this pension pot, they should tell you that. And that's a red flag. If there's any guarantees, you need to speak to somebody like myself and just navigate through that.
Okay. Next one. I have worked for several employers and therefore should have several contributions. Should I consolidate these? If so, and how?
Yeah, so as I was just saying, it's about getting that transfer out statement from existing providers, finding out if there's any guaranteed benefits attached to it. And if there aren't, make a quick assessment about charges. There can be some other reasons, there are some pensions that are quite narrow in terms of the investment options. Well, if you are a 10 out of 10 on risk like I am, and you're looking for specific funds that might be tracking the global stock markets as a whole, they might not be available within, say, an Aviva pot. You might need to use a different provider that you might find on the internet. And obviously, I'm not going to name any names because that could be taken as advice. So,
okay. So, still on the same topic. I've worked different part-time jobs over the years and never opted out of a pension.
Okay.
How can I access them, group them together? I no longer work there and I would not know where to start.
Yeah, so it sounds like this person needs to go to the pension tracing service, get the national insurance number and figure out where these various pots are, then go through that process of the transfer of servicing, asking about guarantees, collating the information. It's probably, you know, a few afternoons on a Sunday, over a period of, normally providers will take between 2 weeks to a month to get back to you. Their service times aren't great. So you'll be stepping into my world of pain when you start doing that for yourself. But you know, today is actually the 29th of February, so it's the extra day of the year that you didn't otherwise have. So maybe now's a good time to do it. And yeah, you can find out if there's compelling reasons to or not. And you know, most financial advisors will help you with this if you want, but you could do it yourself.
Next one, are there any potential fees that I should be wary of when dealing with a pension provider?
Okay, so on old contracts, there might be exit fees, but it's rare. They're supposed to have been abolished by the FCA, but there are sometimes exit fees we find. There are also what's called market value adjustments. So on a specific type of pension pot, if the stock market is down, then you can find a market value adjustment to the fund, which is a cost in effect. You can also, in contrast, get a bonus when you move some of them sometimes as well. But every defined contribution pension pot will have what's called an annual management charge. So when the money's invested, we've got to pay the fund manager a certain amount for investing it. We've got to pay the provider for the fact they're giving the administration of it. So there's always going to be an annual management charge. And there might be some switching charges sometimes. If you move from one fund to another, there might be a charge for that. And some pension funds also have, you know, a £1.50 per month charge, just as a flat fee that also goes with it. So that there can be far more fees than people actually realise. And there are some really low cost pensions out there. Typically your workplace pension scheme, because there is a cap of 0.75% on the charges of that scheme, that will generally be a lower cost pension than something you might have had privately that you might have set up 30 years ago. Where commonly they'd be about 1%.
So definitely worth doing the research before.
Definitely worth looking at it and just consolidating it together. And you know, there are. I mean, I will always give an hour of my time to anybody that's got a question. That doesn't mean they're necessarily going to become a client, but I'll help guide people through. It's not advice necessarily, but I can guide people as to what they might actually end up doing, and just point them in the right direction with things.
Okay, so next one. He's still with us.
Yeah.
How do I take benefits from a pension at retirement?
Yep. So again, we've got the 25% tax-free cash. It might be greater if you've got one of those guarantees and it's an old pot and you had it pre-2006. So we can take tax-free cash. We can also buy an annuity. So that's that life insurance in reverse where you're giving the lump sum and then you're getting the premiums back. And then there's something else called income drawdown where we just chip away at that pot after the tax-free cash has been taken. And we can also take it in small bites of tax-free cash plus taxable income, so we don't have to take the full 25% all in one go. Some people think that is the case, but it actually isn't. So there's a lot of people taking sort of £16,000 a year of income. 12,000 of it would be taxable, 4,000 of it would be tax-free, for example. So they're the three ways. There are no new ways on the horizon. Annuities aren't as popular as they were, which is partly a hangover of lower interest rates. But even now we've got interest rates rising. With the rule change in 2015 and how we can now actually access whatever our pot size is flexibly, annuities aren't in vogue. And it's probably one of the main reasons why people save more now as well. It was never a nice thing to be told that by the time you were 75, you've just got to swap that lump sum for an income for the rest of your life. And kind of the downside of it was that if you died the day after you turned 75, that insurance company kept that lump of money. So that's what people didn't like. It was a bit of a gamble, they felt, but that's now gone. So there's far fewer barriers as to why people should save into a pension than there has been historically.
Next one, and I hope you know what this means because I do not. How do I access my AVCS?
Okay, so AVCs, the additional voluntary contributions is what that stands for. So an AVC pot, if you had a defined benefits pension scheme, say you worked for British Airways and you had one of those schemes, you could save more if you wished, but it wouldn't actually go to increasing the amount of benefit that you've got from the defined benefit scheme. It'd have gone into a separate pot to the defined benefits pot, and it might be dictated that you've got to give up some of the additional voluntary contribution in order to take the benefits. So you've got to check the scheme rules. Sometimes they are just completely detached and it's a separate pot. When you take an additional voluntary contribution pot, if you're starting to take the income, you're triggering income tax and something called the money purchase annual allowance. So there's a few things to look out for. I would recommend, if people have got reasonably large defined benefits with the AVCs alongside, you probably should be taking advice at some point there, because you don't want to make the wrong decision. And there's a whole host of other things that you can do in terms of commuting benefits. So you can swap income for tax-free cash. There's a few variables, but yeah, depends on the scheme rules is the best answer I can give, because it's not a hard and fast thing.
Okay, next one. My daughter currently lives overseas. How can she contribute to a private pension here in the UK?
Okay, so after you actually leave the UK, you can live abroad for up to 5 years and still contribute to a pension in the UK. So even not being resident, you're limited to £3,600 a year gross. So that will actually cost you £2,880 from your bank account, £240 a month. So you can do that for up to 5 years. When you come back to the UK, your allowances are then all available to you to the full amount, and you can actually carry forward unused allowances from the prior 3 tax years. But again, there are caveats to how much that would be. And again, that's probably the point in time, if you're a particularly wealthy individual and you're earning really good money, that's when you should really be seeking advice. There's a bit more complicated thing to work all of that out.
Can you provide advice or guidance on junior pensions that parents can open for their kids?
Yeah, so you can actually be a baby and on the first day of your life have money saved into a pension for you. It might be what particularly wealthy people do. I'd encourage people to look after themselves first. And again, a pension can be used in a variety of different ways. So if you're thinking about gifting money to children, you may not necessarily put money into an ISA. It might be because you can then use the tax-free cash and have had tax relief along the way to give the gift. So it's just a tool in the tool bag. It's not necessarily the thing that you must use, but you can save into a pension for a child from birth. There's a relatively interesting, maybe not, statistic, but if you started saving £3,600 a year into a pension for a child from birth to age 18, by the time that child's 65, that pot will be worth more than £1 million if you compound it at 7% per annum.
Okay. So rich babies with pensions.
Well, it's not necessarily that rich. You're just saving £300 a month gross, but you don't have to be hugely rich necessarily to do that.
Listen, Mum. Okay, so last one, before we go, what are the risks of a lifetime ISA?
Okay, so a lifetime ISA, there's 2 reasons why you might save into a lifetime ISA. It might be because you're building a deposit for your first property. So I suppose one of the risks is that you already own a property and then you can't use it to buy your next property. It's earmarked then for retirement. If it's earmarked for retirement, if you access it before the age of 60, when you take the money out, you're actually hit with a penalty if you access it before 60.
Okay.
So that is a risk, and the risk is a 25% penalty. So actually the penalty is greater than the tax relief you'd have got in the first instance. So it's actually hitting you in the pocket if you do take it out. One of the other risks is the price cap. So we're filming this in London. I know not everybody's going to be in London, but if you're looking at buying a property for more than £450,000, you can't use a lifetime ISA for that. So know what the property is that you want to buy. There is one other thing as well, but I'm a bit hazy on how this actually works, but it's just sprung into my head right now. In terms of how you use the money for the actual purchase, it's in relation to do with if it's partly for the deposit, you can't use it to pay legal fees and things like that. So actually how you use it when you're buying a property can be a bit more restrictive than you might have thought. So don't necessarily count all your chickens when you're thinking I can afford this because I've got this amount on my lifetime ISA. And you can invest lifetime ISAs. They don't have to be cash products. So you can put them into the stock market, same as a pension or a normal ISA. And obviously there's investment risk that you might be taking with that.
Yeah, again, do your research.
Yeah.
Well, thank you, Guy. I have definitely learned a lot from this, and I'm sure that everyone who's joining us live or watching on catch up will also have learned a lot. So thank you. So our next webinar, our next Money Talks, is scheduled for March, and it will be on debt and money management. Thank you, everybody, for joining us.